Hi, my name is John McCallick. I'm an accounting academic at University College Dublin and I've taught financial analysis for over 30 years. So this is the fourth video in a series of videos about how to analyze revenue recognition for companies that you might be interested in. The early video was Introduction to Analyzing Revenue Recognition. I would really recommend that you go back and look at this video if you're not familiar with the terminology of revenue recognition, like performance obligations, like contract assets and liabilities. I really recommend you go back and look at that before looking at this video. If you want more content about services revenue, then I have a video on that, and physical goods revenue in conjunction generally with services. There's a video on that as well. So I guess to have comprehensive coverage, you should watch the four videos here. This video is intended as an educational resource. It is not investment advice. There is no intention to criticize any of the companies that I use as examples. They are illustrative examples only. So let's suppose that a cleaning company has a contract to clean an office block for 3 years. What are the cleaning company's performance obligations? Well, providing the cleaning in January is one performance obligation, performing the cleaning in February, and so on is another obligation. They are considered as distinct. Each monthly service is considered as distinct, but they are provided in a pattern. So how do we recognize revenue? We recognize revenue over time when the performance obligations have been satisfied. So we will recognize revenue in January and recognize revenue in February. In example 2, we're going to look at a construction company, a building company. And this company has a contract to build an office block. This involves digging foundations, erecting the structure and roof, and fitting out the building. Now, what are the building company's performance obligations? And this is an important point. Generally speaking, we see this as one big performance obligation for the whole contract, which might go over multiple years. And the reason we think that is that these services are not distinct. They're not separately identifiable. One cannot be provided without the other. So we have one big performance obligation here. And how do we recognize the revenue? Well, we recognize the revenue over time on progress towards completion. And that can be on two different measures. And we'll use an example here, a company called Mitie, which is, a construction and outsourcing company in the UK. And this is their policy. Project works. The group also delivers project works that include performance obligations under which revenue is recognized over time as value from the service is transferred to the customer due to an enforceable right to payment for performances to date, where the group creates or enhances an asset that the customer controls. So this would be an example of building something on the company's land, and also creates an asset with no alternative use. So Mitie can't, sell off the warehouse that they built for somebody. It's built on the customer's land. And the progress towards completion is measured either using an output method where the value of work transferred over time is based on observable outputs. So this would be a situation where certain parts of the building are complete and can be certified by an architect or something like that, and we can then recognize revenue from that part of the construction. So they say, such as monthly external surveys of work, or an input method where in most cases the most appropriate input is the proportion of costs incurred to date compared to total forecast costs. So this is basically, we're looking at what we're putting into constructing the building, and we're measuring that in terms of the cost that we're putting into measuring, constructing the building. A consistent methodology is applied for projects of a similar nature. And there's also, this idea that variations or amendments, the accounting for them is quite complex. We're not going to get into it in detail, but it can be a concern for some companies where they have a lot of amendments or variations in the contract, and they then have to work out how to account for those. Those kind of things are not generally visible from the outside. You can see maybe the accounting policy for them, but you can't see what's going on, how much of the revenue coming in is in terms of amendments, or how much of the items on the balance sheet relate to those. So we won't talk too much more about that. This is the key audit matter disclosure from Mitie's accounts. And you can see here, you can pause it and read the rest yourself if you want to. For contracts where revenue is recognized over time and meeting the criteria as outlined in key audit matters, we critically assess the appropriateness of the methodology applied by management to recognize income over time using the input method. We tested the accuracy of revenue recognition by evaluating management's process for capturing costs incurred to date and forecast costs to complete. So these are the two things that have to be right in order for revenue to be measured properly. Firstly, we need to make sure that the system of measuring costs is working. And secondly, even more critically, companies should be able to measure the costs that they're incurring. That shouldn't be a problem. But the forecast costs to completion is the real critical point here. We have to make sure that companies are forecasting their costs properly, because the proportion of revenue we're recognizing is the costs incurred to date, which we should know, divided by the cost to completion, which we have to forecast all the time. And in an environment where, say, costs are rising all the time, and there's no clause in the contract that says that the contractor can reclaim these cost increases, then we could find ourselves in a situation where we're recognizing revenue too early. Okay, so we'll see more examples of this later in the video. So this example we're going to go through in some detail. This is a company called Icon PLC. They're a clinical research organization founded in Dublin in 1990. They're now a global provider of outsourced development and services to pharmaceutical, biotechnology, medical device, and government and public health organizations. So they provide clinical trials on a contract basis, and other things as well on a contract basis. And these contracts can run, 2, 3, 4 years. I guess maybe, they might be about 3 years. The average might be about 3 years. How do they measure their revenue? And they tell us that a clinical trial service is a single performance obligation. So this is what I was talking about earlier. They don't say that bits of a contract with the customer to do clinical trials are separate performance obligations. They say the whole thing is one performance obligation. So they reiterate it down here. Promises offered to the customers are not distinct within the context of the contract. And Icon is the contract principal in respect of both direct services and the use of third parties. So a company like this, they contract with the customer, but they may also take third party services as part of the contract, and they bill those back to the customer as part of the contract. So what do they tell us about the transaction price is determined by reference to the contract or change order. That's the modification or variation maybe. And that is the total service revenue and pass-through reimbursable expenses adjusted to reflect a realizable contract value. So don't get confused about these reimbursable expenses. This is where Icon do a contract, but they need to get some services from third parties, and the Icon's customer agree to pay for those services. They are included in Icon's revenue, and then Icon will also include them as a cost. So they go in on both sides. Revenue is recognized over time as the single performance obligation is satisfied. Now, how do we measure that over time? When do we know at what time we can recognize revenue? Well, this is what they say about that. The progress towards completion is based on an input measure being total costs incurred, inclusive of pass-through and reimbursements, at each reporting period as a percentage of forecasted total project costs. So this is, they are using the input method, and to be fair, most people are now using the input method as well. Most different companies are using the input method. So they will look at where are we in the contract so far, how much costs have we incurred, divide that by the expected cost to complete the contract, and then you get some percentage like 72%, and you can recognize revenue, recognize 72% of the contract revenue at that point. You are not looking at specific milestones or, we've done this part of the contract and that part of the contract, and, the client is now happy with X, Y, and Z. That's not how it works. This is a ratio basically of the cost incurred to date divided by the expected cost to complete. So let's look at an example. This is not from Icon. This is just numbers I made up. Supposing you have a contract value of 5.5 million and the forecasted direct costs are 4 million and the forecasted contribution is 1.5 million from this contract. And let's suppose this contract goes on over 3 years. The cash flow in, so when we're able to bill the client, is agreed in the contract 1.6 million in year 1, 1.6 million in year 2, and 2.3 million in year 3, giving us a total of 5.5. And the cash flow out, the direct costs are 1.2 million, 1.2 million, and 1.6 million, giving us our forecasted direct costs of 4 million. The question is, we know we have 5.5 million of revenue over that 3-year contract term. The question is, when do we recognize that revenue? And the answer here is that we look at the percentage of cost incurred. So the percentage of costs incurred, this 30% here is 1.2 million divided by the total costs of 4 million. And then in the second period, 60% of costs have been incurred. This is just on a projected basis now. 60% has been incurred in year 2, and 100% is incurred by year 3. That would be 2.4 million would have been incurred between year 1 and year 2. Okay, so how do we recognize revenue? Well, we take the 30% we've worked out here, which is the 1.2 divided by 4, and we multiply it by the revenue of 5.5, which gives us 1.65. So we recognize revenue of 1.65. In year 2, we look at, we say that 60% of the costs have been incurred at this point, and we take the 60%, we multiply by the 5.5, and we get 3.3, and the recognized revenue for this year, that's the cumulative revenue at that point, 3.3, is again 1.65. And then in year 3, we expect all the costs to have been incurred at that stage, and we recognize on a cumulative basis all of the revenue, and that leaves us 2.2 million to recognize. You can see here the contributions, the profits that will go into the company's accounts are 450,000, 450,000, and 600,000. So that's how it works. In theory, we're just looking at forecasts at the moment. So let's suppose that there are some cost increases as we are going through the contract. So what happens is the actual costs for year 2 are 1.6 million. We had forecast 1.2, and the expected cost to complete have risen to 4.5 million. Our original forecast was 4. Now this means it's a less profitable contract than it was. Our contribution from this contract has been reduced by 500,000. Our costs before were only 4 million. So now the cash flow out has increased to 1.7, and the cash flow out in year 3 has increased to 1.7, and the total is now 4.5 as opposed to 4. So what happens to our revenue recognition? Well, this is the number we need to work out. And what is that? Well, we take the 1.2 plus the 1.6, that's the cost to date. And that is what? It's 2.8. And we put the 2.8 over the new costs, the new overall cost, 4.5. And we get then the 62.2%. So that's putting up the amount of revenue we can recognize slightly in this in year 2 of the contract. It puts down the amount of revenue that we recognize in the 3rd year because there's less of the costs being completed here. So it completely reorganizes our revenue recognition when the forecasts of costs that we are expecting over the term of the contract changes. Now, companies have whole teams of people who are constantly working on these cost forecasts for contracts that are longer than a year. So we need to have some confidence in the company that they are providing, that they are constantly updating these costs. Otherwise, they could recognize revenue back at the start of the contract, and then by the time you get to the end of the contract, there's no revenue left to recognize, and the costs of the contract have gone up, so it actually turns out to be loss making and stuff like that. So in some UK companies this has happened, where they've been recognizing lots of revenue in the early years of contracts, and then they have to take big cost write-downs as the contracts develop. So all of this accounting means that we're going to have contract assets and liabilities, rather large amounts sometimes of contract assets and liabilities on the balance sheet. And the timing may differ between the satisfaction of performance obligations and the invoicing and collection of amounts related to our contracts with customers. This is taken from Icon's annual report. So unbilled revenue. That's what Icon call it. This is actually a contract asset. So the IFRS terminology is contract asset. We record assets for amounts related to performance obligations that are satisfied but not yet billed. So, we have incurred the costs and we are going to recognize the revenues associated with those costs, even though we don't have a right to charge the client, and the client has not become a receivable yet. They are recorded as unbilled revenue and are therefore contract assets rather than accounts receivable. So they haven't got to the point of being accounts receivable yet. And unearned revenues, liabilities are recorded for amounts that are received in advance of the or at least become due in advance of the satisfaction of performance obligations. They are essentially, we have billing in advance of revenue being earned. So either of these two things can happen in a contract situation. So this is another example here. I've set up the numbers here to show us how contract assets will work. The situation is the same as before, more or less, but I have changed the numbers a bit from the previous example. So we have cash flow in here, 1.4 in the first year, 1.4 in the second year, 2.2. It all adds up to 5. Cash flow out, the direct costs, 1.3, 1.3, and 1. The percentage of costs incurred are here, 72.5% in the second year and 36.1% in the first year. And we recognize revenue of those numbers there, 1.81, 1.81 and 1.39 million. And that's the cumulative revenue up there, which obviously goes up to 5 when the contract is complete. So let's look at the cumulative revenue there and then compare it to the cash flow in from the customer. And we will see that revenue is recognized before we have, and by cash in here, I mean, it could be, receivables as well. It could be, it might not actually be cash received, but receivables. But let's just keep it simple. We compare revenue and it's running ahead of our billing here. So we have a contract asset at the year end of $410,000. And at the end of year 2, our billing is running well ahead of our ability to, or our revenue is running well ahead of our ability to bill the client. And there's 810,000 of contract assets. Of course, at the end of the contract assets have all gone away. We've, cash from the client and revenue recognized should be the same at the end of the contract. Okay, so that's how contract assets arise. And then this is, I've changed the cash flows here again to demonstrate what it would look like if we end up with contract liabilities. So we basically have the same situation here, have we? But I've changed the cash flow in billing numbers. And when we compare cumulative revenue, that's revenue for, the contract so far, to cash in, we see in the first year we're able to bill the client for more than we're recognizing as revenue. And that is creating a contract liability at the year end. Okay. And the same thing in year 2, we're able to bill the client for more. And then, of course, at the end of the contract, it all reconciles. The revenue is going to be the same as the cash in by the end of the contract. When we bill and recognize revenue from the client, they may not pay immediately. They won't pay immediately. In this case, the amounts are classified as receivables and, they will come in as usual. And people are quite interested for contract type of companies to see how their receivables are behaving. It's one of the things people look at to try and decide whether revenue recognition is working or not. They like to see, receivables being received and not, remaining a constant percentage of revenue, or the receivables days staying stable. So that is something people like to see in contract companies. So here's the note from Icon PLC's balance sheet, and you can see they have billed services, so they have 1.7 in receivables. There's an allowance for credit losses here, a small allowance for credit losses, and then there's unbilled services, or they call it unbilled revenue. This is um, contract assets, okay, and then they have a line on their balance sheet which is account receivable and unbilled revenue, or accounts receivable and contract assets. Okay. So here is some information from the auditors of Icon PLC. We identified the evaluation of revenue recognition for clinical trial services as a critical audit matter. Complex and subjective auditor judgment was required to evaluate the customer's estimate of total forecast project costs. So the auditors are forecasting on the process that the company has to forecast these costs. You can pause the video here and read the rest of the slide if you want about the kind of things that the auditor looks at to make themselves happy with those estimates. Okay, there's one more thing that I want to talk about in relation to contracts, and that is revenue versus bookings, or book to bill. And bookings are commitments from clients to purchase goods, services in the next period. And a lot of contract companies that rely on contracts for their business will disclose some kind of bookings figure. They might call it something else, but I might call it backlog or something like that. And billings are goods and services shipped this period. So they're essentially revenue shipped this period. And the book to bill ratio is bookings over billings. It's a non-GAAP measure. Companies can calculate it in whatever way they want. This is just a kind of an average way of doing it. And bookings are an unaudited, I should say unaudited number there. Or maybe I've said are not an audited number. Anyway, they are not audited. I can't see my own slides with my picture in front of them. So they are not audited. So, you've got to take the company's word for that. This is some information from ASML, the company based in the Netherlands that makes chip etching equipment. Very successful company. And they give you a net bookings figure up here, and it's 5399 for this quarter. And then we have our quarterly summary consolidated operations down here, and they give you down here a sales figure. And to get the book to bill ratio, we look at the bookings over the billings, and we get a ratio of 0.72. So I guess you like to see a high ratio here. You like to see that the company has a business that's going to be coming its way in the near future. How exactly this is defined varies from company to company, and you probably need to look into, the notes to the accounts, or sometimes at the very back of the financial statements there will be an explanation of how they work out these things. And how far ahead they're looking for the bookings, and is it the same period as you're dealing with now, and all of that. So buyer beware on that statistic. So a summary of what we've done here. What is the nature of the company's contracts? This is a question you should be asking. Are there distinct performance obligations, or is it all one performance obligation? How long are the contracts? Are the contracts like 3 or 4 years long, or are they even maybe up to 10 years? Are you building nuclear power stations or submarines or aircraft carriers or something like that, in which case the contracts could be very long? How is revenue recognized? Is it on the input method, observable inputs like costs, or output, certified completion? And the example that we saw there was on the input basis. If based on costs, how are the estimates to completion made and updated? So this is a critical question. Now, unfortunately, we can't observe much of this from the outside. We may be able, for some companies, to look at trade journals and stuff like that to get some idea of how they're doing with their large contracts. But for other companies, we have to rely on them having a good internal system for keeping track of costs and, even more importantly, keeping track of forecasted cost to completion. There just is a high level of uncertainty here when you're dealing with multi-year contract. What are costs going to do in the future? The costs of the inputs that we need to the contract, are they going to go up? Are labor rates going to go up? And are we have we committed to a fixed price for the contract with no cost increases clauses? And there is potential here for companies to recognize too much revenues early in the contract, and then by the time we get to the end of the contract, the contracts turn out to be loss making. We don't have a good way of detecting this from financial statements, to be honest. I mean, the only thing we can do is keep an eye on what the levels of revenues, contract assets, contract liabilities, receivables and billings are, and how they're changing over time. Okay, thank you very much for watching. Please like the video and subscribe to the channel if you're interested in content like this. Have a good day. Goodbye.